You are listening to Influencers from the Conference Board.
Hello and welcome to this edition of Influencers, the Marketing and Communications podcast by the Conference Board. My name is JP Kuehlwein. I'm principal at Überbrands Consulting, teach at NYU and Columbia Universities, and lead the Marketing Institute here at the Conference Board. And today we'll zoom out a little bit, not just look at brands and marketing, but at the company overall, and focus on how they are valued. Everyone seems to have an opinion on what companies or brands are worth, whether it's Wall Street, Main Street, or wherever investors and employees live. But it also seems like those values can be quite far apart and even move in opposite directions over time, or depending on who looks at it. Here to help us make sense of all of this and find a better solution, hopefully, is Tim Koller. Hi, Tim. Thanks for joining us today.
Hi, JP. Thank you for having me.
Excellent. Tim knows a thing or two about corporate finances and valuations. Believe me, he's a partner at McKinsey and Company based in New York. But I think Tim is in Stanford. We'll get to that in a second. He's a core leader of their strategy and corporate finance practice, which he also helped found. And he advises clients on topics such as value creation, corporate strategy, investor relations, dividend and share repurchase policy, et cetera, and of course, mergers and acquisitions. So he has a lot to do with evaluations. And students of finance, whether professional or academic, will know him because he's co-authored what I would describe as the Bible of valuation. It's a book about measuring and managing the value of companies and has just been republished in its 7th edition in May 2020, which must mean it's a good book. Thanks again, Tim, for coming on the show today.
Thank you.
So before we get started on valuation, tell us, where are you joining us from this Monday morning?
Well, today I'm joining you from my home in Connecticut. We've been holed up here for the last 5 months or so. Fortunately, my daughters have all been able to come home, and so everybody's working from home and getting together in the evenings for dinners.
That sounds romantic. Do you think it's something that will endure, or do you think once the famous vaccine is around or the virus has disappeared in some other way, we're going to lapse back to mostly going to offices? How does it look for McKinsey?
For McKinsey, I think we're going to see probably more of a hybrid approach. We do most of our work at our client locations in any case. So a lot of the consultants don't spend that much time in our offices. But it's nice to get together in the office for social reasons and get to know people better in person. So I would suspect that there will be less time in the office, but not zero necessarily. So that's and a lot of it will also depend in terms of working with clients when they're ready. And we'll probably do more with clients by video as well. Instead of spending 4 to 5 days a week there, the team may spend 2 or 3 days a week there. And do other meetings so they'll be able to travel a little bit less. So I do suspect that there will be some less travel and more use of video technologies.
That makes sense. Any obvious impact on valuations as far as virtual working and doing commerce and selling is concerned?
Well, it really, you mean for McKinsey? Sorry, or
for McKinsey and in general, do you see big kind of impacts as far as valuations of companies are concerned?
So in terms of valuations of companies as a result of the current situation, it varies so much from industry to industry, and even within some industries. So, for example, if you look at retailers, you see that the grocery retailers and the general merchandise retailers are doing quite well. On the other hand, the apparel retailers have been hurt really quite bad because most of that depends upon people going to store. It's a discretionary purchase. So it varies a lot across industry, and the valuations are also consistent with that. If you look, even though the stock market, let's say the S&P 500 as a whole, is not too different from where we were at the beginning of the year before the pandemic, you'll see that some sectors are up as a result of this, and some sectors are down, and it just tends to average out so that the stock market as a whole is about where we were before the situation.
Right.
So, the good news is the market is discriminating. They're not just sort of applying the same discount to every company.
Right. And as far all things being equal, working office work virtually, i.e., dispersed over homes mostly, versus in the office, is there a clear indication as to how that impacts the value of a company? Is it a good thing because there's less real estate cost, less building management, etc., or is it unclear because there are costs that we might not even be fully aware of today? There are costs for working from home. Is there a clear indication on that level?
Yeah, well, certainly for businesses on the office side of things, most of us expect that over time there will be somewhat less need for office space, which will save companies a little bit of overhead. A lot of the manufacturing and services themselves, though, the cost for those won't change. So from that perspective, there would be a small benefit, but it's for most companies, it's not large enough to, the occupancy cost for a big manufacturing company, for example, of the offices as opposed to the factories,
Right.
isn't a big material cost.
Right. Right. Okay, well, let's plunge into valuations. As I said at the top, you co-authored the book on it. When I look at it, it is a very thick, a thin-paged, heavy book on this subject. And the first thing I thought when I took it into my hands is these authors must be very, very passionate about the subject. What makes you passionate about it? What is so exciting about valuating companies to you?
What makes me so passionate about the topic and willing to write the book 7 times over 30 years and continually update it is not the valuation per self of a company, but how it influences a company's strategic decisions. I think that's one of the big purposes of our book and the work that we do with clients is to help companies make better strategic decisions that will maximize value over time. And so we use it more as a tool to help companies figure out what are the levers that will help them increase value over time. And that's one of the reasons I'm passionate about it is because I still see a lot of techniques and other ways of thinking about value creation that don't make a lot of sense. So, for example, one of the things we talk about, the main thing we talk about in our book is that valuation, the value of a company is driven not only by its earnings, but also by its return on capital. And so companies that just focus on earnings at the expense of return on capital won't receive very high valuations. Vice versa, there are some companies that just focus on return on capital. The key is to figure out what the right balance is for your company. And so the work that we do with companies is to help them really understand what the levers are. Should I focus on revenue growth? Should I focus on margin improvement or capital efficiency? Or how should I treat different businesses in my portfolio? Some of them I should focus on revenue growth. Some of them I should focus on a margin and return on capital improvement. So that's why I'm excited about it, is because of the impact it has on companies' decision making and their value creation over time.
Now that makes sense. Two questions on that. One is, do you have an idea of what the percentage is of from small to large size companies, and there's probably differences there, of companies that actually track their value? That would be my first question. And then second, I worked at Procter & Gamble for a long time. We were always talking about total shareholder value. The concept was probably quite clear. The execution was a little bit black box. Who needs to understand it? How do you rally employees around the concept of value and how it evolves in a company? So I guess first, who uses value, and then how do you make people follow and understand it?
Yes, companies that use value range in size from a couple $100 million of revenues, maybe less, and up. Any listed company is always concerned about that. Probably more so tracking the share prices on a daily basis. We find that most, except for um, fairly small businesses like little restaurants or whatever, that everyone is of a decent size is focused on value creation. So it is something that is important, certainly to the top executives in any company. As for the rest of the organization, we spend a lot of time also helping organizations and helping people understand what creates value. And I think that's important. And it's not so much the valuation or the technical issues, but what are the principles that ultimately matter, right? So, for example, if you've got a plant manager, it's important to teach the plant manager that the return on capital, which is the operating profits divided by the amount of capital that's tied up in his activities, the physical assets, the working capital, et cetera. It's important for that plant manager to understand how that affects the valuation so they can see what their contribution is to value creation over time. One of the things that's also important is helping companies focus and the organization understand it's all about long-term value creation and not trying to maximize the share price today. I can easily pump up my share price by cutting costs, but that may damage the business longer term. And so it's important for people in the organization to know that there's a lot of evidence that says you have to, the more long-term you oriented are, the more you focus on your employees' satisfaction, they're more productive. It's important to please your customers, be innovative, always be ahead of the competition when it comes to serving your customers, even if it costs you a little bit in the short term. So it's important also from the perspective of helping people to understand that this is a long journey for companies, and it's not just about cutting costs today in order to convince the market that the company's a little bit more profitable, even if those cost cuttings will damage the business later on.
Right, right. Now, I have a segment in my graduate class on brand strategy where we talk about brand valuation. And as we do that, students find that there is more than one way. In fact, there are quite a few ways of attempting to value a brand, and that behind those different ways are different philosophies, if you like, on how brand value is created. I suppose the same applies to companies, particularly those who have a lot of goodwill, soft assets, which will depend a lot on these brand valuations. Can you tell us a little bit about maybe fundamentally different approaches or philosophies of how to determine a value? Because when we talk about valuations, there will be not just one way of doing this, right?
Yes, but it does boil down to one sort of principle, which I think is mostly universally accepted by bankers, investors, and corporate executives, right? Ultimately, the value of a business is driven by the cash flows that it can generate. You make some investments today, and you generate additional cash flows going forward. And ultimately, any investment that you make, whether it's a bond or whether it's if you're an investor buying a share of stock, or you're a company running your business, trying to decide what to do, how to make investments and stuff like that, it ultimately boils down to the cash flows that you can generate. And I think there's universal agreement to that. More and more, you'll see that in M&A transactions by bankers, in analyst reports, and certainly what investors do, sophisticated investors. They are focusing on discounted cash flows in driving the value of the business. One of the things that's important to know also is that the cash flows of a business are ultimately determined by how fast that business can grow and what kind of return on capital it earns. It's a combination of those two things that ultimately drive the cash flows. So I think that's important to realize, that there is, I think, universal agreement upon what drives the value of a company. That said, there are short-term proxies that people use. Oftentimes, people will use some sort of price earnings ratio or a market to book ratio. Nowadays, instead of using price earnings for most non-financial companies, they'll use a measure called enterprise value divided by some measure of operating profits, often called EBITDA, where they take the debt and the equity of the company and divide it by the operating profits of the company and then compare it to other companies to sort of see. The danger with using those proxies, if you're not careful, is that if you don't compare them to companies that have the same financial characteristics as you will be led astray. And so ultimately, it is sort of still goes back to return on capital and growth and cash flow, regardless of how you're thinking about this. Even companies that are so-called unicorns that may not have any cash flow today, ultimately what matters is the amount of cash flow that they'll be able to generate as they mature. And a lot of the more sophisticated tech companies that don't have big cash flows today, they're very focused when they make investments on the cash on cash return from those investments. So there is universal agreement for the most part on the importance of cash flow as a driver of, and not just earnings, right?
Right.
If you do a good job with return on capital and growth, you'll not only generate good cash flows, you'll generate good earnings, but you can generate earnings growth without good cash flow, and that could, in many cases, destroy value.
Right. We'll get back to those unicorns in a second, I promise. But I didn't want to quite let you go that quickly on valuations, particularly these more softer valuations around, how much is Coca-Cola worth? How much is, I don't know, SpaceX worth? There seems to be a component in there that goes beyond cash flows towards factors like, I don't know, believe in a vision or something like that. I like to show my students some studies. One of them is by Markables, but there are others, Markables in 2015, where analysts have compared valuations, in this case, in my case, by brand agencies like Interbrand or Millward Brown and so on, of brands that fortunately or by coincidence were sold to somebody or bought by somebody, depends on how you look at it, within a couple of months of those valuations coming out. And they found absolutely no correlation. I mean, there were differences in the assessed value versus what the acquirer paid of up to plus minus 500%, meaning 5x, which is outrageous, obviously. And it doesn't seem to get better. How do you explain that? Are all these analysts just bad at their job, or is it truly difficult? Because at the end of the day, the value of a company is in the eye of the beholder, or rather in the eye of the investor. And they might just think that it's incredibly valuable where others don't see it, i.e., for example, famously, Mark Zuckerberg got a lot of criticism for buying Instagram at what seemed like an insanely high valuation, and now it's worth a lot more. Or what is it that makes these valuations apparently so imprecise?
Well, valuations are imprecise because if you change the assumptions a little bit, the value can change a lot. So if you, for example, change a growth assumption for a business from 4% to 5 or 6% over the next 10 or 20 years, that will have an enormous impact on the value. So valuations are very sensitive to small changes in the assumptions that you're making. So that's one of the reasons. And that's one of the reasons why we focus primarily on how do you increase the value of the business as opposed to trying to come up with a precise estimate of the valuation. But in terms of the broader issue around brands that you raised, if you take a branded consumer packaged goods company or a branded beverage company, right, where there's a lot of value from they have great brands or whatever, people recognize those brands. What you find is that the value of that business, it's very difficult. First of all, the value will be very much higher than the book value of the assets. The book value of the assets is sort of irrelevant for companies which earn a high return on capital. because that's what, once again, investors are interested in earnings and cash flows. And one of the things we find, though, is that it's very difficult to take one of those companies and to separate out that value that's generated by the cash flows from how much of is it the brand, how much of it is the management capabilities in managing that brand, how much of it is the distribution system that they've got in place. And so trying to say what's the value of a brand inside of a inside of a company that has great brands, but taking the brand itself and separating it from everything else that the company does is very difficult. We, when working with clients, tend not to worry so much about the components of that extra value, that valuation. The difference between the cash flow value and the book value, right? Which you could say is, the intangible value, which is the value of the brands and everything else that the company does. But it's impossible, we find, to take those apart. So anytime you try to focus on the brand itself as opposed to something else, it's very difficult to sort of say what that brand would be like in isolation. And it's only in the rare cases is where only a brand is sold that you can actually see what somebody might pay for a brand. And I think every transaction where brands are sold, they vary. What tends to happen is that it's not always clear that you're always selling the same thing. Are you just selling a brand without any manufacturing, without any distribution, et cetera? Or are you selling a business that happens to have a brand attached to it, right? So those things will have an enormous effect on comparing these, so-called brand values with the, with the transaction value, and right, ultimately, right, the transaction value is going to be a function of how much the buyer thinks they can generate additional cash flows from owning that brand.
Right. And I've been part of a couple of acquisitions. It still seems to me that beyond the hard numbers, there's always some emotion involved as well. If people love a brand, if you get to buy a Ferrari, maybe you're more emotional about that acquisition than if you buy, a Chevrolet, without wanting to judge one or the other. We have to turn to the elephant in the room as well, which are the unicorns that we've talked about. And I think bigger picture, a phenomenon that seems to confuse most lay people, but I think even professionals, which is there seems to be a disconnect between a company's financials, i.e. its ability to make profits or to generate positive cash flows, as you said, and its valuation. And then more recently, but also over time, there seems to be also this disconnect between what Main Street is observing in terms of the current economy, as well as the perspective of how the economy might evolve, and Wall Street and how the stock market is doing. They seem to be sometimes at loggerheads or going in completely opposite directions. So I'd love to talk about, how that apparent contradiction can be resolved, but we first need to take a little break for some quick announcement. So we'll see you on the other side.
Can you, your team, or your company benefit from insights such as the ones provided in this podcast? They are immediately available when you join the Conference Board, a membership-based think tank that delivers trusted insights for what's ahead. Reaching across industries and geographies, we bring together our noted experts, senior executives from the world's largest companies, and nonpartisan practical research to help you address your most important business issues. Our membership packages are tailored to your organization's unique needs and budget. To learn more about our offerings, go to www.conferenceboard.org and click Join on the top bar to connect with one of our product specialists.
Hello and welcome back to our conversation today with Tim Koller, who's a partner at McKinsey and a guru when it comes to company evaluation. And Tim, I was asking you before the break about these this apparent disconnect between what seems bottomless pit companies when it comes to generating profit. I'm talking Airbnb, Uber, Square, Spotify, you name it. Take your pick. That seem to nevertheless be, much sought after by investors. How do you explain these very high valuations and the apparent, deep red that comes out of these companies in terms of cash flow?
Yes, those are very important questions, and we get those all the time. And some of them are probably not justified, some of those valuations. So first of all, let's talk first about private companies for a minute, companies that haven't gone public yet. In the private market, there's only a handful of people buying and selling the shares. So it's very easy for the value to become disconnected from what the intrinsic potential of that company might be. Because you only have to find one person who's willing to pay a high price to get an enormous valuation, right? And we have seen that in some cases when those companies have gone public, the share prices haven't held up, or they haven't even been able to go public because the valuations put on it by the private investors were way out of line with reality. So let's switch over then to listed companies. Two things are going on. One is what matters is the long-term potential cash flow generation of some of these businesses, not what they're doing today. And so what we will often do is reverse engineer and say, okay, given today's share price, how much would this company have to generate, let's say in 10 years, in terms of revenues and profits and return on capital to justify today's value? And then you can look at it and say, is that reasonable or not? Or is there a reasonable probability that that could occur? So sometimes we look at them and we find that, yeah, that's the case, that, you're not making any money right now, but, they are a leader in their market. Their market is growing fast. And once their growth starts to slow down, their fixed costs will remain constant. They will generate profits and cash flows, and the value can be justified. Not with certainty, of course. There's a lot of risk. In most cases, these businesses, we don't know, could be 50% chance that they'll succeed and 50% chance that they'll fail. But it is important, or one approach is to reverse engineer and to say, what would you have to believe about the potential performance of this business in order to, longer term, in order to justify that value?
Right.
So that's one way to approach it.
Isn't there, I mean, coming from a company that's a quote unquote, traditional blue chip, isn't there something unfair in this, quote unquote, in the sense that I fully understand you say, hey, look at Amazon. Yes, it's a tiny little plant, a fragile little plant, or Tesla. But if we project out them growing at this rate, for a long time, and they've invented e-commerce and they've invented electric cars, I can see where they become a dominant brand and very valuable. However, isn't it unfair where at the same time Walmart says, hold on a second, if you would let me off the whole shareholder value thing and I can make the kind of losses that Amazon does, or if me, General Motors or BMW are let off for, give me 5 years where I can generate a cumulative $10 billion in losses. I will give you the greatest electric car possible on earth, but you don't allow me to do that like you allow Elon Musk to do it. How do you respond to that? Is there a psychological component, like the new guys on the block, that have the hype and the visionary storytelling? They're allowed to do it, but the classic company doesn't get that break.
Well, I think, the question is whether or not investors believe that the management team has the ability to do it. Right? Many of the larger companies are mired in they have a certain way of doing things, right? They have, big processes in place as to how they make decisions. They're not nimble. They're not quick in making decisions. My guess is in the case of, say, automobile companies, that it's not that investors don't want them to develop electric vehicles, and they are all developing electric vehicles. But I think that they feel that, that they're not necessarily set up to be the most innovative, right? And so it will, that's one of the reasons why there's sort of a lack of trust. Isn't a good track record of companies, larger, more mature companies, doing these kinds of things in a big way. So in most cases, investors are just skeptical about that management team's ability and the bigness of the structure, trying to run a large company and simultaneously create something new that will also cannibalize the core business. So I think investors just have a skepticism about the track record in some of those cases, right? One way to overcome that is to go private. Some companies have gone private and been able to spend time sort of revamping the business. Another is to ignore some of the noise from the stock market. There are lots of investors out there who are long-term oriented, who would like companies to invest more for growth, as long as they can tell a good story about why they're going to succeed. And I think a lot of corporate executives have a misperception about which investors matter. The loudest investors are often the short-term investors because they need news. If I'm investing on momentum or the next piece of news, I'm going to be spending a lot of time talking about what's happening right now, right? There are a lot of investors out there, important investors, who probably have more influence on the share price that aren't so vocal. And if you had a compelling story about the investments that you were going to make, we found that those investors would be comfortable with that. Maybe not so extreme, because you don't need to spend billions and billions of dollars often to do these things. But we do think that there are opportunities for these companies, if they have a good idea, if they can manage it well, to do the same kinds of things.
So you say it's trust and belief, and it's kind of the sparkling object on the other side. It's greener on the other side of the fence. So I guess to some extent, the quote unquote hype, the kind of marijuana smoking, gaming, interesting tweets, tweeting, etc., is actually part of value creation. Is it not?
Well, I think there's another element which is important, though, which is, first of all, sophisticated investors will see through that hype, right? They don't like fancy presentations. They don't like all this sort of tweeting and stuff like that. I'm talking about sophisticated institutional investors. So that's not going to get you anywhere, particularly if you're a larger, mature company. What happens, though, is if you look at some of the companies which have extremely high valuations relative to their performance, if you look at their shareholder base, you'll find that they are often much more heavily retail owned than other companies, right? Typical US-based company, probably 60 to 70% institutional ownership. And if you look at some of these real high flyers, that may be reversed, right? And retail investors aren't as sophisticated. They get excited about the story, and they'll jump in, and they can cause a company to be overvalued, for quite a number of years. Eventually, the share price will come back down into line with as the company matures, if they demonstrate the cash flows, the share price will come down if they are overvalued. But we have seen bubbles in the past. We saw bubbles in different sectors over the last 20 years. We saw the dot-com bubbles in 2000. We saw bubbles in some of the electric utilities. We've seen bubbles in biotech. So these bubbles come and go, right? They don't last. They can last for several years, but eventually the share price catches up with or comes down to the level of the cash flow generation. And one way to check and see if you think there might be a bubble is to look at the share ownership. If you see a high percentage of retail owners, then you need to be skeptical about whether or not this is being driven by emotions or cold hard analysis driven by these sophisticated investors. And one of the reasons why share prices can stay high for some of these companies is because it's very difficult for short sellers to push the price down. And because short selling is very risky. So you end up with situations where companies can be way overvalued for a period of 3, 4, 5 years before they come back into line. Usually it's only a handful of companies that fall into those categories. So where the public, where the retail investors just get overly excited about them.
Right, right. Now, Keynes said, in the long run, we're all dead. So I guess the people who make large profits in the short term might be smiling a bit at this. Let's time's running out. This is a fascinating subject, but I wanted to get to this one last big theme that is going around at the moment, which equally seems to puzzle people or even upset people actually emotionally, which is Wall Street seems to be doing fairly well, as you said at the beginning. If you take out certain industries like hospitality, travel, the usual candidates as far as COVID impact is concerned, it's doing exceptionally well. And then the rest of the economy, the normal people, Main Street as it's called, they're reeling, and not just in the short term. It looks like high unemployment is there to stay for a while. How do you reconcile this enthusiasm on Wall Street and kind of the doom feeling on Main Street, expressed also in things like gold price being quite high, interest rates being low, other things associated with recession?
Yes. Well, first of all, I think it's actually sort of a good thing that the stock market has held its value because ultimately the beneficiaries of the stock market are, the stock market is held by pension funds, people with their retirement accounts, 401ks, et cetera. So in a time when the economy is in the doldrums, it's nice that their savings are doing okay. So it's not necessarily a bad thing. There's a couple of ways to explain what's going on, though. I think one of the most important things that we need to realize is that the stock market is a different composition of companies than what is in the economy itself. So, for example, the stock market is dominated, or the largest percentage value in the stock market is technology companies, pharmaceutical companies, medical device companies. Those kinds of companies. Those kinds of companies have not been hurt very much. In some cases, they've benefited from this situation. At the other end, where there have been large employment losses, are often smaller companies that aren't even represented in the stock market. So, for example, restaurants. For the most restaurants, are not listed companies, right? So, the employment, where employment is mostly down, is in places that aren't represented in the stock market. The stock market is not a picture of the economy anymore. It has shifted. And even when you look at an industry like apparel, or retailing, apparel retailers, they're obviously way down as well, but they were already struggling, many of them, and were already a very small percentage of the stock market. So their decline doesn't have that much effect on the overall stock market. So you have a disconnect here between where employees actually work and where employees are losing their jobs, and the kind of companies that have the largest positions in the stock market. In addition to that, a lot of U.S.-based companies, a lot of larger ones, derive a lot of their profits from outside the U.S., so that helps them as well. So this difference between the companies in the stock market, or where the stock market is weighted and the economy is weighted, is what accounts for some of that difference. The second thing that accounts for that difference is the fact that investors believe that this is we're going to get back to normal in 2 or 3 years, right? So if profits and cash flows return back to normal in 2 or 3 years, or close to normal in 2 or 3 years, if you do the mathematics of discounting those cash flows related to those profits, you'll find that the long-term impact on the valuation of companies shouldn't be that large, maybe 10%, not an enormous amount. And what we've seen in most recessions like this, or most serious recessions, is the stock market does drop. It overreacts. It goes down way too far relative to the mathematics, which suggest, and then it comes back up. And this has happened in 2009. The difference this time is that it went down very quickly and came up very quickly, right? So what happened is the share prices went down real fast, went down 30 to 40% for the market as a whole. And then investors, a lot of more sophisticated investors said, these values are too low if we don't believe that this will have a long-term effect on the economy and that within 2 or 3 years we'll be back close to normal. Then the mathematics says that the valuation shouldn't have come down so much.
Right. Interesting. I think on Marketplace at NPR, they say the stock market is not the economy is not the stock market. I think there's one more perspective and data point on that. We've run out of time, Tim. Isn't it amazing? I mean, how fascinating valuations can be, but you knew that already. If people want to continue the discussion, if they want to learn more, I know you're very prolific as far as papers and so on go. Where should they look you up? What's the best way to read and listen to more of what you're thinking about valuations?
Well, the best place to go is to go to McKinsey.com, the strategy and corporate finance practice page. Has all of our publications related to valuation and other strategy issues. That's the best place to go. The other thing to do is to go to McKinsey's LinkedIn page, and you'll see most of the publications there that are coming out related to these topics. And we have a whole series of topics coming out related to valuation over the next several months.
Excellent. Well, thanks again, Tim, for joining us today. That was super interesting. And thanks, listeners, for tuning in. If you found the episode helpful, then don't be shy. Let us know through your comments, ratings, and so on. Subscribe. You know the drill. And look at all the other podcasts we have in the offing at the conference board. You can find that at conference-board.org/podcast, just to make it a little bit easy. And with that, I want to say thanks again, Tim, and see you soon.
Thank you. Thank you for having me, JP. I enjoyed it.
This has been Influencers from the Conference Board.